Hi, I'm Jason Todd, CIO for 10Cat. Welcome to Meet the Expert series.
On the one hand, you've got equities that have rebounded, and global equities ex the US are back at their peak. In the US, if you exclude the Mag 7, which have had separate issues, they're within 5%. So that's the market saying, you know what, there's not a lot of damage here. Whereas when you look at some of the sentiment data, market and real world people are still absolutely rattled by what's happening. And I think that gap between the two is now becoming quite dangerous. I think equity markets are becoming quite complacent about the risks of a cycle downswing, a recession globally and in the US, and that worries me. I don't want to be technical about it, but we didn't actually get to a bear market. But I think the risks are skewed to the downside, particularly in the US. And ironically, I would have said that even if Kamala had won last year, because the US just looked very expensive, very over-owned, and the faith people were putting in the whole AI trade, which was really the catalyst for driving the US up over the prior 2 years, just seemed to me way too toppy, way too exuberant. Mr. Trump has catalysed a lot of reasons to think that the US is going to underperform for potentially quite some time. So in that sense, I think we're in a world where rallies, particularly US rallies, I'm much more willing to sell them than to buy the dip. My sense is it's fast money and retail that have been willing to buy the dip. I talk to a lot of very large investment pools. They're still coming to grips with what the whole new Trump administration is going to mean for them on their typical 5 to 10 year time horizon. And that means they haven't started to move yet. When they do, I think that will absolutely swamp what the fast money have done over the last 3 weeks, from the Liberation Day lows to almost getting back to the peaks. That's just going to be froth. And it's going to be these other people that determine the trend. And it's another reason that I think the US is going to start to underperform, because I cannot see that they're going to look at what's happening and say the US is as attractive today as we thought it was 6 months ago. I think the Trump administration is going to operate as a big adverse supply side shock to the US economy. For the rest of the world, it's a big demand side shock. Now that means that the central banks face different incentives. For the Fed, it's going to be quite tricky. We could get a slowdown that it won't be able to respond to in the usual way by cutting rates, because the supply side means that you've still got inflation pressures that are uncomfortably high. For the rest of the world, a demand side shock is a very straightforward thing to respond to. You loosen policy, a combination of monetary and fiscal. Now, the banks won't be doing that to keep risk markets up. Their focus will be on the real economy. But obviously, the incidental benefit of them tackling a macro shock with lower rates will be to help risk assets outside the US. It's another reason to think that this year, the rest of the world could do a lot better than the US, because at the end of the day, central banks have got more scope to ease outside the US than if the Fed's dealing with an adverse supply side shock. My sense is they haven't started to move yet, except at the very, very margins. And these are organisations that tend to be thoughtful and they don't react fast. And that's partly because they've got such large pools of capital, they can't throw it away around. And they judge themselves on strategic time horizons. And therefore, they make very considered decisions. They are still digesting what the whole advent of the Trump administration in all its facets. And it's not just an equity market question. It's Trump seemingly insisting that they chip in for treasuries, and the whole idea of a Mar-a-Lago Accord where we force our funders to take long-dated bonds. Is this going to persist? Is this consensus? Is this a 2-year thing? Will Mr. Trump come back to them? This is the debate. But I come back to the point I made earlier. I can't see anybody sitting down after what's happened in the last 100 days and going, yep, let's allocate more to the US. I mean, it's either they keep their allocations where they are or they reduce them. And my bet is very much that they're going to start to reduce. And one of the ironies of what Mr. Trump is doing is he's creating the circumstance for people outside the US to do what they should have done anyway. I mean, China should be moving more to a consumer-led economy. Germany should be doing more fiscal stimulus, should be spending more on infrastructure and defence. Mr. Trump's catalysed those changes, so all of a sudden now you potentially have carrots and sticks. Some of the disruptive, seemingly not very well thought out policies in the US are providing a bit of a stick for people to look elsewhere, and now you start to see carrots. Okay, perhaps Europe will get better. Perhaps China won't have the deflation problem. It'll be a consumer-led economy. Now, all this is going to take time to play out, but that's why this performance of US versus the rest of the world does tend to trend over multi-years. One of the things we have to remember that when interest rates were, as they said, at 5,000-year lows back in 21-22, everybody termed out, including VC operators. They're about to roll over with rates several hundred basis points higher. There's a cycle that is going to slow at a bare minimum, but if it's a recession, you could have, for them, a really difficult overlap of macro stress with funding stress. And, they mark their own homework for now, but when they try and liquidate some of those positions, you could see a lot of disappointment for holders of private assets. I thought the campaign was quite dispiriting. I think Australia's got real structural macro problems, which neither party put front and centre and seem to have any great suggestions for fixing it. And as I said, the biggest single macro problem is we don't do much investing. In fact, if you look at investment share of GDP ex the miners, we've been at levels for the last decade that we've only ever seen at the worst point of the deepest post-war recession. So we've had investment spending at recession-like levels. And that CapEx is being stretched over a very fast-growing population. So if you look at CapEx per person, which drives productivity, we've had no growth in the capital stock per worker for 7 or 8 years, no productivity growth for 7 or 8 years, so you can't have real wage increases. And if you do try and get that, it's just going to be inflationary. Can we break out of that rut? I think we could if we really put the policies in place. I'm not sure that we will see that, and it's quite a disappointing thing. Now, it's only 3 days after the election. I guess the government can now assume it's going to have 2 terms. It's hard to see it'll lose next time. So hopefully that gives it the courage to put through some reforms that will improve that structural outlook. Transfer to what that means for equities here. Look, we've had fairly tepid earnings growth outside the COVID reopening for the last 6 or 7 years. We've got quite a premium valuation for how low growth has been. It's not like low growth means we look cheap. We don't look cheap. And my view is particularly ex-mining, we've got ritzy valuations. So you've got to really know your nuggets to find the value in that market, because the macro doesn't look that supportive and the valuations don't look that attractive. So as an asset class, I'm not in love with it. Doesn't mean you can't find value among individual names. I just don't think equities look a particularly good risk-reward proposition at the moment. We've rebounded a long way from the sell-off caused by the tariff announcement. Okay, Mr. Trump has backpedaled on some of them, but the world is not where it was before Liberation Day, and equity markets are almost at the stage of saying it is that good. And I just look at that and go, you're not priced for a hard landing, Mr. Equity Market. Do I think the risk of a hard landing has gone up over the last 2 months? You betcha. And that's not in the price. So I think this bounce that we're experiencing is at pretty high risk of fizzing out. And as the hard data come in, which are almost certain to show a slowdown through the June quarter, I think equities, the risk reward is slanted to the downside.